GameStop Saga, Unpacking the Lessons from a Wall Street Uprising. Hello and welcome back to Forum Finanzia, where your financial journey is our priority. Thank you for your continuous support in reading our blogs and tuning into our videos. Recently, I finally watched Dumb Money, a film not exactly new, but new to me. It brilliantly captures the whirlwind that was the GameStop stock market saga of 2021. This film not only reignited memories of those crazy financial times, but also prompted me to think deeper about what it all meant. In today's video, we're delving into the high-stakes world of finance as portrayed in Dumb Money, and how it aligns with the real events that played out with GameStop's stock. This episode, marked by a dramatic showdown between everyday investors and colossal Wall Street hedge funds, marked a pivotal moment in stock market history. I may not have been directly involved in the 2021 trading frenzy, but the insights garnered from this period are priceless. Our goal today is to go beyond just revisiting this sensational story. We aim to unearth practical insights and strategies relevant to your personal finance and investment journey. For both the veterans in investing and those just beginning, understanding these events is key to skillfully navigating the complexities of the current financial landscape. Let's learn from the past to better our financial future. I hope you find this insightful. The GameStop Phenomenon. Let's dive into the remarkable story of the GameStop Phenomenon. In early 2021, an event shook the financial world to its core, an event we now call the GameStop incident. What started as a movement by retail investors, many hailing from the Reddit community wallstreetbets, turned into a massive buy-in of GameStop shares. This was a game changer for the company, which had been struggling while big-time investors, especially hedge funds like Melvin Capital, were betting against it. At the heart of this saga was Keith Gill, or as he's known on Reddit, Deep King Value, and elsewhere as Roaring Kitty, a chartered financial analyst with a strong belief in GameStop's undervalued stock. Gill's consistent analysis and updates on social media began drawing in a crowd of retail investors. As more people started investing in GameStop, the stock price soared, leading to a dire situation for the hedge funds that had shorted the stock. They faced substantial losses, a classic case of a short squeeze. This story was brilliantly captured in the movie Dumb Money, which dramatizes the clash between regular investors and financial elites. It's a vivid portrayal of how the power of social media and community platforms like Reddit can empower ordinary people to make a big splash in the world of high finance. The GameStop incident is a prime example of the power of collective action and the significant impact of social media in finance. It demonstrates how the internet has leveled the playing field, allowing retail investors to have a substantial influence in the market, a role traditionally held by large institutional investors. This event is a testament to the evolving nature of the stock market in our digital age, highlighting the strength of community-driven investment strategies and the disruptive potential of social media in traditional financial systems. As we reflect on this, it becomes clear that there are crucial lessons here for modern investors about the changing landscape of finance. Investing lessons from the saga. Now let's distill some key investing lessons from the GameStop saga. This story wasn't just a financial anomaly. It brought to light the evolving nature of the stock market. First up, understanding market dynamics. The GameStop incident demonstrated a shift in market power dynamics. No longer are market movements solely influenced by big institutional players and corporate actions. We saw how individual investors, united by social media, can collectively impact stock prices, like what happened with GameStop. Next, let's talk about the risks of short selling. This strategy, where investors bet on a stock's decline, can backfire, as it did with GameStop. When the stock price rises unexpectedly, short sellers scramble to cover their positions at higher prices, leading to significant losses. Another key takeaway, the power of research and community. Keith Gill's deep analysis and active engagement with the online community played a crucial role. His insights on GameStop's value galvanized a movement. This highlights the importance of thorough research and being part of informed investor communities. Lastly, we must consider the volatility and risks in speculative trading. GameStop's stock experienced extreme fluctuations, demonstrating the high-risk nature of such trading. It's crucial for investors to recognize the difference between investing based on fundamental analysis and speculative trading driven by market trends or hype. These lessons remind us to stay informed, be cautious with high-risk strategies, and value the power of community and research in our investment decisions. Broader implications for personal finance. The GameStop story isn't just a tale of stock markets. It's a lesson in personal finance, too. Let's dive into some broader implications. Firstly, ethical and legal considerations. The saga prompted a heated debate about market manipulation. Was the collective buying by individuals, coordinated through social media, a form of manipulation? While seen as a counter to hedge funds short selling, it brought to light the gray areas in market ethics and regulations. As investors, we must be aware of these legal and ethical boundaries to avoid potential pitfalls. Now let's talk diversification. GameStop's roller coaster ride is a stark reminder of why putting all your eggs in one basket can be risky. Diversification across different assets and sectors is key to mitigating risks and cushioning against market volatility. Then there's the long-term versus short-term investing debate. Sure, some made quick money with GameStop, but such gains often carry high risks and aren't always sustainable. Long-term investing, rooted in fundamental analysis, offers a more stable path, focusing on steady asset growth. And finally, the importance of independent analysis and critical thinking. Being part of a community is great for insights, but don't get swept up in the herd mentality. Do your research, understand the risks, and align your decisions with your financial goals. Independent, informed decision-making is crucial in the complex world of investing. So, from ethics to investment strategies, the GameStop saga has much to teach us. Embracing these lessons can lead to more informed, responsible financial decisions. Personal reflections. Now let's get a bit personal. Reflecting on the GameStop frenzy and its depiction in Dumb Money, I'm struck by a mix of fascination and caution. The film brilliantly captured the intense emotions and the wild ride experienced by those caught in the middle of it all. It really brought to the forefront the collective energy and that David versus Goliath vibe, where everyday investors took on the financial giants. It also shed light on the growing influence of social media and community spirit in finance, a trend that's becoming more prominent in our digital era. As for my own stance during the 2021 GameStop rush, I chose to observe from the sidelines. The whirlwind around GameStop stock was undoubtedly thrilling, but it clashed with my investment philosophy. I've always leaned towards long-term, value-driven investments, steering clear of high-risk speculative plays. That's not to say I don't see the allure in these high-octane trading moments. The energy of retail investors rallying together is undeniably captivating. But for me, it's about aligning with my own risk tolerance and investment goals, staying grounded amidst the market's excitement. Watching the GameStop saga unfold was an education in itself, reminding us of the importance of knowing our investment boundaries and not getting carried away by the heat of the moment. Final thoughts. As we wrap up our discussion on the GameStop incident, let's highlight the key lessons that redefine our approach to modern investing. First, the undeniable power of collective action in the stock market. GameStop's story showed us how retail investors, united through social media, can profoundly influence market dynamics. It's a shift in the power dynamic of the financial markets, demonstrating that retail investors can indeed stand up to institutional giants with the right strategy and unity. Secondly, the incident shed light on the high risks of short selling. It's a stark reminder of the dangers lurking in this strategy, as GameStop's soaring stock price caused huge losses for short sellers. This highlights the need for investors to be wary of the unlimited risks inherent in short selling. Third, we learned the value of thorough research and community influence. Keith Gill's in-depth analysis and his engagement with the investing community set off a wave of collective investment action. This underlines the importance of doing your homework and tapping into the collective wisdom of investor communities. Next, the volatile nature of speculative trading was brought into sharp focus. The extreme ups and downs of GameStop stock are a prime example of the risks involved in such trading. While there were quick gains for some, others faced steep losses, underscoring the importance of risk management in investment decisions. Lastly, the saga reminds us of the evolving stock market landscape. As technology and social media continue to integrate into our lives, their influence on financial markets is growing, shaping new investment scenarios. In conclusion, responsible investing is about understanding these trends, aligning them with your risk tolerance, investment goals, and ethical considerations. As the market evolves, staying informed, adaptable, and prudent is crucial. For more insights on personal finance and investing, don't forget to subscribe to our channel. We regularly explore topics to help you navigate the financial world's complexities. Thank you for watching, and here's to making informed and smart investment decisions.